Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hello and welcome to today's Top Stock Pick segment. I am Jeremy Mullen and I will be doing Palo Alto Networks, ticker symbol PANW. The stock is a Zacks ranked #1 strong buy that is a best-in-breed cybersecurity name. The company offers network security solutions to enterprises, service providers, and government entities. The stock has been one of the best performers of 2023, and a recent earnings report has strengthened the bullish vision for the company. I think the stock gets over 200 soon and even takes out all-time highs. For that reason, any dip should be bought, but before we do that, let's go over my bullish case. Okay, here is the profile page for Palo Alto Networks. As you can see, we're a Zacks #1 rank. The company was incorporated in 2005 and is headquartered in Santa Clara. That's in California. It employs over 12,000 and has a market cap of 58 billion. If you go down here, you can kind of see that. Looking at the style scores, we have a F in value, but an A in growth and momentum. So valuation is going to be an issue for some people. If you look down here at the forward PE, we have a 48. So that's a little high for some people, but I'm going to talk about the recent earnings, which allows the investors to justify this valuation. Basically, their growth is so strong, they're going to grow into this valuation. So we'll talk a little bit about that. A little more of the company. What do they do? Well, they offer firewall appliances and software subscription services for cyber threats, cloud security, professional services, and more. Of course, there is strong demand in today's world for those types of products and services. And so they are just seeing a whole heck of a lot of demand for what they do. Okay, let's dig into the earnings. This is the price and EPS surprise chart. So looking at this, you can just see they've never missed on earnings. Now back the last couple of years, the bottom line didn't matter as much as billings. So there was billings momentum for each quarter. You can see they had earnings here, and the billings were probably bad, and the stock tanked. Right here, they were probably good, and the stock went higher. But if you look at this beat, 35% EPS beat, this is the largest in history. And I think that bottom line beat is now going to start being a huge catalyst along with those billings. So digging in those numbers, Q2 came in at 105 versus the 78 cents expected. The company guided Q3 at a range of 90 to 94 cents versus the 79 cent expected. They also raised their total billings for that quarter. They now expect 9.1 to 9.2 billion versus the 8.95 to 9.05 billion, so a little higher there. Their year-over-year billings came in at 2.03 billion versus the 1.6 billion expected, so huge growth there. Management cited the performance of their software-based and cloud-delivered portfolio as a reason for the ability to raise that guidance. So a lot of positive out of this quarter. And with that, analysts are hiking their estimates. So let's take a look at that. Here I am on the estimates page, and what I like to look at is how many analysts are in agreement here. And look at them. They're all hiking estimates over the last 60 days since earnings, except for this guy here. Who knows what he's thinking, but the rest of them are loving what Palo Alto is doing and hiking estimates. Look at the magnitude of that. And you can see how much they are hiking estimates for. So for the current quarter, we see 79 cents to 92. That's a hike of 16%. And then all the way down the line since earnings, we see about a 15% rise in the next quarter, current quarter, and next year. So very positive momentum there. And not only are analysts hiking their estimates, they're also hiking price targets. And I wanted to go over a couple of those. Citigroup, they have a buy on the stock. They raised their price target from 195 to 220. Piper Sandler has an overweight on the name and raised their target to 240 from 220. And then Morgan Stanley is the bullish one I saw on the street. They reiterated their overweight and have a 255 target, which is up from the previous target of 240. So when you look at the stock trading at 190 today, tremendous upside when it comes to Morgan Stanley's view. So let's look at the charts and see how we might get to Morgan Stanley's targets. Okay, here's a chart looking back about over the last year. This is the all-time highs for the stock, and of course it went down with the market sell-off If you're looking at the stock and you thought it was priced much higher, well, it was. They saw a 3-to-1 stock split. So the equivalent of today's price, we were around $600 a share. The stock split here, and we just kind of meandered for the rest of the year into the end of the year when it really saw some selling. So, but with the market, it rallied back up to the 200-day moving average, struggled a little bit, got over that before earnings, and then we had this recent quarter in which it has taken off. Okay, so what I have here is kind of a short-term trade setup that I've had up since it broke its Fibonacci 61.8% retracement. What this is, I draw from these highs to lows. I get a nice little line here, which was resistance. It got above. And what happens when it breaks this resistance, I target the 161.8 extension, which is 208 here. So what I think is going to happen is the stock will come up to here. And there is actually a potential catalyst. The stock is rumored to be added to the S&P 500 soon. So what that might do, if there's any short-term spec traders out there, you get along around here in a news like that, we probably shoot up to 200 and hit these targets. Now, that's really close to all-time highs, and you figure if we get here, we probably do take out those highs. But one thing I've noticed with a lot of stocks, especially tech stocks, once they do take out these highs, we do see retracement of some sort. So I would definitely be taking profits and look for some kind of backfill to re-enter. And let's look at the bigger picture there for you long-term investors who just want to hold this thing. This is what I have. I have from a Fibonacci drawn up from those all-time highs to this year's lows. Once again, we broke this 61.8% retracement from that move. And what that gives us is a macro target of 161.8 at 263. So that kind of lines up with that Morgan Stanley target there, right? So that's a pretty solid move, and I think that is doable into the end of the year. Okay, Palo Alto is posting big numbers and seeing earnings growth in a tech sector that has been struggling. The company is best in breed in cybersecurity, and investors should expect PANW to lead the sector in 2023. Buy the dippers should take advantage of any sell-off and look to move above all-time highs into the end of the year. Okay, that's it for me and my top pick. Here is Shiraz with his.
Thanks, Jeremy. The stock I've picked, folks, is a tech stock that had blockbuster numbers last week, and the stock jumped on the quarterly release. Salesforce.com, ticker CRM. I've created a couple of slides that I want to share with you, so let's jump right into it. So in here, is the stock price performance, and I'm not doing percentage changes, it's just the dollar stock price over the past year. You could see here how the stock had a 15% jump on the quarterly release. And you could see that the stock has really come up strong from its the lows at the end of last year, in fact, in Q4. Here I'm going back. It's a 2-year performance. It's Salesforce relative to the S&P, relative to the Zacks tech sector. So after the recent strong momentum, as you could see here, the blue line, CRM is essentially in line with the tech sector, but lags the broader market. And it's still significantly down from where it was in late 2021. So a brief comment on the quarterly release I mentioned last week. I was a beat and raise quarter. They guided towards better margins and also a buyback authorization. The positive follow through on the stock is essentially a reflection in the market that management is now committed to profitable growth. The issue with CRM for the market all along has been their drive to achieve growth at any cost. And what the latest quarterly numbers showed to the market that they are on the cusp of and committed to squeezing all the efficiencies out of their system to give us profitability and sustain growth at the same time. So it's this profits first approach as against growth first approach, which the market sees as the correct strategy for this stage of the cycle when the economy is slowing down and business spending as a result is moderating. And even though cloud space still represents a major growth area within the broader technology area, but this focus on profitability is the way to go for CRM. So estimates have started going up. They had started going up ahead of this release as well, but it's reasonable to expect that as analysts update their models and come up with estimates, it will continue to be to the upside relative to the trajectory the stock has been lately. So in the next couple of slides, I want to address the question of valuation. Obviously, we saw earlier how the stock has run up, and then the question after any such run-up always is it worth considering for someone? And I'm hoping that we get close to an answer to that question after looking at this. So the sell-side analysts typically use enterprise value to sales, enterprise value to free cash flow, and obviously a price to earnings or PEG was here. So this is the enterprise value to forward 12-month sales. As you could see, this is a 5-year chart. It's trading at 5.28 or 5.3 times at present and has come up since the bottom. But over the last 5 years, it has traded as high as 10.5, as low as 3.76, which is where it was over here, with a median of almost 7 times. So on this metric, enterprise value to forward 12-month sales, it's below the 5-year median. I mentioned the free cash flow as another metric, enterprise value to free cash flow. This is the trailing 12-month. And as you could see, it's currently trading at 29 times. Again, over the last 5 years, as high as 71.7, as low as 22.6. Median is 40.7, 29.04 or 29 times. So over the last 5 years, this isn't the lowest multiple, but it's below the 5-year median. If we go to the PEG ratio, again, the 5-year period, 3.4 times at present. Over the last 5 years, 13.09 or 13.1 times on the high side, low 2.68 or 2.7, and the median is 5.55. So again, below the 5-year median here as well. The takeaway from this valuation discussion is that if you're looking at CRM as a tactical trading buy, then given the run-up the stock has had since late last year, it's not clear if that momentum will continue. But if you are a long-term investor, if you're looking at CRM as a potentially long-term holding beyond the next 12 to 18 months, then it's fair to say given the valuation history we just saw, that even though it may not be the cheapest relative to other tech stocks, but relative to its own history, uh, it is fairly compelling. And if you have an appreciation for CRM's core positioning within the enterprise software space, if you have an outlook for the long-term favorable outlook for cloud as an investable space, then CRM is as good a long-term vehicle to play that outlook as any. And this is the primary reason why I'm recommending CRM as a quality long-term pick at a relatively reasonable price. That's it, folks, for this week. See you guys next week.